All right, how's it going, everybody? My name is Antonio, and I'm here today on October 10 with Brandon Yurik, the CEO of Electric Royalties, which, well, as you might have guessed, is a royalty company focusing on a range of commodities, really, including your obvious, sort of battery metals, so lithium, cobalt, and nickel. But there's also other stuff in there like tin, vanadium, graphite, zinc, and of course copper. Tell you more about it in a second. But who's not here with us today, though, is your financial advisor. This conversation is not going to include any recommendations to buy nor sell nor do anything really. It's just a talk. It's a casual talk between two people. So for as far as you as the listener or viewer are concerned, this is going to be a conversation that's general and impersonal nature, as well as a conversation that is definitely not meant to be used as independent research, because it's also going to include a lot of forward-looking statements about uncertain events that may or may not happen in the future. What that means for you is that, first of all, you might want to pause the screen right now and read the full warning that is on your screen, because the mineral exploration, development, mining industry is among the highest risk industries out there. So if you care about your money and you don't like losing it, please do more research by visiting the company's website and analyzing its official filings on setter.com, as well as, of course, consult a professional investment advisor before taking your own decisions in the end. That all said, Electric Royalties is a $20 million market cap company, which is divided over about 96 million shares outstanding, and that makes this a 20 and a half cent stock as of today. There are almost 18 million warrants and 6 million options, which means there are about 120 million fully diluted shares. Stock trades on the TSX Ventures Exchange under the ticker symbol ELEC, where an average of about 30,000 shares trade a day, with a 52-week low of 19 cents and a 52-week high of 40 cents. Company currently has about $200,000 in cash and about $2 million undrawn on a $5 million credit facility. Credit facility, by the way, is at an interest rate of 7% plus SOFR. It is capped at 12.5%. So with the interest rate environment right now, that is also the effective interest rate. That's a convertible loan, though, which means that if the lender were to choose for it, this could be paid back in shares. But the lender is not allowed to own more than 19.9% of the company, which we'll also be talking about here. This is against current liabilities of about $1.5 million, consisting, of course, primarily of that convertible loan for this. I believe it's 1.4. I cannot read my handwriting, but I think it's 1.4 million of the total sub account is that convertible loan, and then the rest is some account payables. Electric Royalties has royalties on two producing assets, one of which is in the U.S. It's the Middle Tennessee zinc mine, where they have a sliding scale gross royalty, which, as far as I understand it, and give me some rope here, I'm not the brightest of bulbs, but it's basically the royalty that Electric would get starts to apply when the gross mining revenue of this mine is higher than 90 cents per pound of zinc. So in other words, if the operation generates less than that in gross revenue, then they get no royalty. Pretty low cutoff, though. Well, it's not super low, but again, something that we can talk about. This is
it's actually the price. It's a price threshold. So
okay.
if zinc prices are below 90 cents a pound, they do not have to pay anything on the royalty.
Right. Yeah.
And so if the royalty is between 90 cents and $1.10, or if zinc prices are between 90 cents and $1.10, it's paying out, I think, 1%. And then if zinc prices are above $1.10 in the market, then we get paid 1.4%. So it scales up as they're more profitable. We get more money back as well.
Exactly. And that's the sliding scale.
I just wanted to jump in just to help you out there.
No problem. No problem. As I said, not the brightest of bulbs. I was struggling, so appreciate the help. And so this is the sliding scale that I was also trying to explain. Mine is operated by Trafigura, by the way, and it's expected to generate about $500,000 in annual revenue, if I'm not mistaken, right? And then the Penouta mine that you were talking about, this is for the people listening. This is the second one, so this is a 1.5% gross revenue royalty, and it's on Europe's largest tin and tantalum mine. With again the Penouta mine, it's in Spain. And Electric, you paid what you've paid now, $2 million, 250,000 in cash, and then in addition,
2.25 million in cash, and then there was a small share portion. I think it was 125,000 or so in shares. And so, we first financed them in January of this year. As part of that deal, we had an option to double down on that, and we just financed the game in August. So
Right.
yeah, we love it. They're really Europe's only tin mine, if you can believe it. For all the money sloshing around to kind of secure these critical metals, North America, Europe, and Australia have a long way to go on some of these. But yeah, no, we love the management team there. They've been steadily ramping up production, and we're expecting that one's going to pay us, around $500,000 a year, moving forward as well. So,
Right.
yeah, we're excited about that. We see a lot of potential, and it's obviously related to tin in terms of revenue, and I think tin is one of those commodities we're probably the most excited about. So.
Right. I do want to talk about more in depth here in a second when we get to it. On top of that, I was also going to say that you have 20 under royalties, and it's of various percentages. So it's ranging between 0.5% and up to 2.5%. Also at various stages of development. So that'd be between pretty much early stage exploration through PEA up to engineering studies. This is something on the screen right now. Or people watching if they want to see it. So in total, there's the zinc mine, then the zinc royalty, then there's the tin and tantalum producing royalty, but then there's also 3 graphite royalties. There is 7 lithium royalties. There's 2 copper royalties, a nickel copper royalty. There's a nickel standalone royalty. There's 2 manganese royalties, a vanadium royalty, 2 cobalt royalties, and even a tin silver royalty. That one is in the exploration. Well, actually, about 60% of these royalties are on projects that are in the exploration stage. So we have 5 in total at the PEA stage. 2 are doing their engineering studies, and again, 2 are producing. 70% of all those royalties are in the US and Canada, so that's a total number 15 in being in the US and Canada. Then about 20% or 4 of those are in Australia, and then there's 2 in Europe, Spain, as I said. There's 1 in Norway as well, an interesting one, and then there's 1 in Madagascar, which is an island off the coast of Africa, because why not? But so as of the last financial statement, which covered the first half of 2023, there was $70,000 generated from those royalties. But I'm thinking by the end of the year it's going to be a whole lot. Do plan on finding out. So yeah, I guess that about does it for the overview. Let's I guess fire up the grill. Give Brandon here a sizzling welcome. So thank you for your bravery, I guess.
Yeah, no, looking forward to it. I appreciate you having me on.
A pleasure. So my message that something is wrong with my microphone. Can you hear me just fine?
Yeah, I can hear you fine. Yeah.
Okay. Weird stuff. Zoom does its thing. But anyways, this is your first time here in the hot seat. So I'd like to start off by I guess getting your assessment of your own company, but to prevent you from thinking your hamburger is the best looking, why don't you give me sort of 3 things that you like about the company, followed up by 3 things that you would change if you could do so by the turn of a knob?
Yeah, sure. Well, look, I love where we're at from an asset standpoint right now. You mentioned we have 2 producing royalties already. We have 20 more royalties in our portfolio. Since we've acquired those over the past 3 years, over $500 million has been raised by operators. So, at no cost to us, and that's all going in the ground to develop our assets. Adding value for us at no cost to us. And so I think the royalty business model, and the fact that we already have 22 really strong royalties, all in good jurisdictions. And really what we've been trying to do is get those best in class assets in Europe, North America, and Australia that could be domestic sources of supply of these metals. And so when you look at it from that standpoint, there's not very many, and we've already got royalties on a lot of the best, lithium assets, manganese, graphite, et cetera. And so, I think there's a lot of push and impetus to have these projects come into production that you might not see in the traditional kind of gold mining space. And we don't have to do anything, We've probably got 1,000 people working on our projects right now. And our G&A is very low, I'm the only full-time management in the company. We've got everything's, outsourced through back office. So we run very cheap. We expect to be cash flow positive here, over this course of this next year. And G&A is like $1.5 million, right? So, we've already got about $1 million. We've also got advanced royalty payments now coming from Biscuit Creek, which is a fantastic graphite project in Ontario. And we expect our Oche lithium royalty to come into production here, in the near future. It's already fully financed, just going through the final permitting process. So from a point of view of, we are in a great point of view, our great position that we don't have to do much, right? We've already got a great portfolio. It'll do a lot of the work to get us out of there. Our valuation obviously sucks, but that's kind of a double-edged sword. Our company's actually fairly tightly held. Myself, my family are, about 15% shareholders. I'm personally, about 95% invested. So don't find too many CEOs that are that invested. We've got Stefan Gleason, who's been a very supportive shareholder to us. He owns about 20%. And then, our very initial partners that we did our first deal with, Globex, they still own about 8% as well. So, just between those three groups, we're about, 50% or so. So that the valuation part is tough where we're at, but, we don't have too much loose stock out there, and I don't expect it'll be there. And sorry, so you wanted one good, one bad, and what was the other?
No, it's just I actually do 3 good and 3 bad to make it real hard on you.
Oh, 3 good. Well, look, I think the space that we're in, I think, if you kind of go from a general point of view, we have no competition right now. We're the only group out there, doing financings, royalty financings for a lot of these metals. We did the first graphite royalty financing ever done. We did the second and third tin royalty financings ever done. We're one of the only groups out there that looks at manganese. We've got the second largest lithium royalty portfolio that's been put together globally. So it's kind of fun from that standpoint, and the growth profile. There's not many times in life, I think, where you see kind of 2 decades runway, but that's really what I see with this space. This is a space that didn't exist, right? 5 years ago, and you're talking about basically cannibalizing the oil and gas sector, over the next kind of 20, 30 years here. And the oil and gas sector is, traditionally about 5 times the size of the mining sector. So, I think that a sector that didn't exist, to be, trying to target and take over that kind of an industry, the growth profile is something that I don't think we've seen before. And then, I think I kind of touched on too the royalty business model and kind of, where we're at from our portfolio perspective. But there's lots of other positive things that we could talk about there. In terms of one more negative, I think from the point of view that we kind of just have to bide our time, like we're not, I think we're a buy and wait, we're not necessarily a buy and you're going to be able to, get your money out tomorrow. The liquidity part is kind of tough, but, we're a very safe buy and hold. At the end of the day, companies, we've had 40 different updates from companies on our portfolio over the summer alone. And lots of progress happening on that front. We're going to be continually active, looking to add more cash flowing royalty deals. And so I think we're, at the precipice of a re-rate here, and hopefully that brings with it, some greater liquidity as well. As you can get some bigger analyst coverage as well as we get bigger and stuff. So, I think we're at a turning point here. I'd be a lot more, I think, desperate. You mentioned our cash position, right? And where we're at on that front. I would say that you mentioned warrants as well. So 18 million warrants, 9 million of those are to Globex. They're all at 60 cents a share. So that's obviously a much higher share price than we're at today. And I told you, so our G&A is about $1.5 million a year. That includes also, some legal costs to keep doing deals. And we've already got about $1 million, incoming from revenue. So where we're at right now, I mean, even though it looks bad from a cash position, we do have that facility with Stefan Gleason, our very large shareholder, that we could draw down if we need to. If we're going to take capital, we're looking for a strategic investor, someone that's going to bring something else to the table. And we're going to be, we're looking for equity, but we're not going to be raising money at these prices. We've never raised money at these prices. We went public 3 years ago at 25 cents a share. So, I don't expect that we're going to be here, for very long, to be honest.
Well, something that you mentioned right there was interesting to me when you said that you've got no competition, and the royalty model is definitely an interesting one. But we also have we've seen quite a lot of royalty companies emerge over the last 5 years, and in those specific niches that you mentioned, like your manganese or tantalum or whatever. Sure, there's not many companies focusing on any of that. You do have a large lithium portfolio, as I said, 7 lithium royalties, I believe, and most of them, like most royalty companies, as far as I understand it, do have niches. But it looks to me like picking a niche. If we keep the tempo of royalty companies of new royalty companies, picking a niche might not be enough, as in soon enough royalty companies will have to sort of pick a niche within the niche. And I know I'm not making much sense right now, so I'll try to elaborate. But like you, for example, you say in your presentation that you focus on long life assets with exploration potential and near term production. It's like that. It's great. Like that's literally what everybody wants, right? A cheap asset, quick cash flow,
Yeah,
long
yeah,
term sustainable cash flow,
yeah.
and
They want
upside
the
potential.
golden goose. Yeah, yeah.
But it like is that really like, can you keep that up as a sustainable strategy over the next 5 years? And basically what I'm trying to ask you here is, what is the primary objective for acquiring property? Is it growth? Is it size? Is it soon cash flow? What are you focusing on first?
Yeah. So definitely value, right? We look at stuff, we want to get value. And so like a lot of the bets that we made kind of earlier on as we were getting going were on some earlier stage properties that, quite frankly, just to give you an example, Canset lithium royalty that we have, our Seymour Lake lithium royalty, those properties, since we've acquired them, they've raised over 150 million. They've brought in partners. We're expecting economics to come out on those that are going to look, very, very accretive for us. And so like, there's some deals that we did that are kind of a little bit earlier stage like that. But right now, what I mean by competition, right, is there's very few groups out there that are doing financing for any of these metals right now. Like I said, we kind of have free run of the board. The royalty groups that even did, look at, say, like nickel, copper, Nova Royalties would be a great example, just acquired, for 7 times where our current valuation is. Those guys only bought existing royalties, right? So they buy them from the original guys that staked the land. When they passed that land on to the next mining company that said, we're going to develop this over the next 15 years, they got a piece of paper that says at the end of it, you get a royalty. They're kind of, pretty tough agreements, but, it's because they're very small, right? They're written by a guy that was out there staking land 15 years ago. He didn't know what he had on the property. They don't usually cover the whole project. You can't do due diligence on the asset. Like we do a pretty deep dive because we're directly talking to the company at a stage where we know what the deposit is. We do drill modeling. Like we do a pretty deep due diligence. And, we're approaching these guys at a time where we believe they have, need for capital. It might be a good time where royalty might be something that fits for them. And so there's no competition because we're creating that royalty, brand new. We're approaching them. It's our idea. And so there's kind of two parts to it. We're one of the few groups out there that actually creates new royalties by financing companies' development. And on the commodity side, I'd kind of go further in terms of we also stay away from private equity groups. Private equity has a really firm deadline or kind of, mark where they can't do anything pre-PFS. And so I love PEA stage projects. Frankly, they're one of my favorites. Because we can't, those guys can't enter. And sometimes the difference between a PEA project and a PFS project is infill drilling. And if you know the mining space, that's a tough money to go get. So a company might need 5 million to go do some infill drilling. But you talk about the risk profile between the two, they're not that different. And so we love, opportunities like that. And then also on producing stuff, the big private equity guys, they don't do anything under 5 million. So, when we're playing out there, we're typically under 5 million, looking at that kind of deal size anyway. And so from that point of view, we also have no competition, there either. So we're pretty careful. I think right now, obviously, like you said, we have this opportunity. I said, as we move forward, I think, the opportunities will probably get a little bit, tougher to find. Like it is in the gold space, but you mentioned all those royalty companies, 90% of those guys are gold focused, forgetting about the guys that create new royalties or not. There's 90% or more, have all been traditionally to the beginning of time, have been precious metals focused. So, we'll see. I think it's crazy. I think there's, you look at the prices those guys pay in the space on the precious metal side, compared to what we're paying. And I think, there's definitely, incentive for people to come over and start doing deals on this side.
How does doing deals actually work, by the way, in reality? I mean, if, I don't know, let's say you get abducted by aliens tomorrow and they won't, for some reason, want me to take over your job. What am I going to have to do? Like, do I have to go down to the projects, check them out? Or is this more of a desktop study type of decision process?
Yeah, well, you don't have to do anything now because we've already got those royalties. Yeah, yeah. I mean, you can. On some of the royalties that we created, one of the benefits of when you create the royalties is you get rights like that. So if we wanted to go do a site visit, if we wanted to audit something, we have some rights like that. I mean, that's the thing about royalties. I think it's why, you look at a lot of family offices and wealthy families like to store their money in royalties because they're very long-term recurring cash flows. Some of our royalties we expect to pay for 40, 50 years. And they're very minimal, maintenance. We don't have to do anything. There's no holding cost to them. We have no operating cost on a unit basis. They just basically send us a percentage of cash flow. Most of our royalties are gross revenue royalties as well, by design. And so it's straight off the top, no deductions. It's very hard for, a group to kind of hide anything from that. So yeah, no, if the old CEO got hit by a bus tomorrow, it'd be really, unfortunate for me, but the company would be fine. Our growth profile might be a little bit, stunted, but it would be very easy to sell the company. Quite frankly, we've been looking at a lot of processes lately. The sales processes on royalties portfolios, have been absolutely crazy. So who knows? It could actually be a better, value strategy for you guys in the immediate term.
That's why I said abducted by aliens. It was just a little bit less violent there. Those.
Yeah, well, I guess it could have been fun,
Maybe they bring you back, all those people on Netflix that they always get brought back. So,
yeah.
but well, let's talk about some of the more advanced stage royalties that you have. Again, there's 22 in total. 2 of those are already producing. So I do want to talk about those first. Penouta. Penouta is actually an interesting one. Because it's a 1.5% royalty, but it's got some sort of a rule on it that could bring it back to 1%. How's that work?
Yeah, so it's actually 2 separate royalties now that we've combined into 1.5%. So we got a 0.75% when we financed them in January, and then we got another 0.75% when we financed them in August. So it's basically a step down. So once we've recouped all the capital that we've given them, plus a little bit of on top of that. So I think it's plus 30%. Basically, that royalty would drop from each royalty drops from 0.75% to 0.5%. But that royalty then would be there in perpetuity. And, they've got mining license for 30 years, renewable up to 75, at their current mining rate, it'd take them at least that to get through it. But it's built in there so that as we've already recouped our capital back, a bit of a step back. It's pretty common, I guess you can say. There's usually more painful things that groups have in there, like they can actually buy back 100% of the royalty. We would never do a deal like that.
But how long is that going to take, the step back?
It should be about 5-6 years, all kind of, as is. I think the exciting thing about that mine specifically for us is that they have the potential to double the plant production, and now they need to go raise some money for that. That would cost, probably 10-12 million bucks. But, as Europe's only tin mine and, as a group that's, showing that it can be done, I'd expect that would happen at some point, in the near future here, in the next few years. And so that's just kind of the exciting thing, right? All of a sudden they double plant production, our cash flow's expected to double. So that timeline could change, but yeah, 5 or 6 years probably be, a good bet.
Okay. And how much do you expect you're going to be getting in cash flow from that for those 5 to 6 years?
Yeah. So right now, we're expecting that it should get up to about $500,000 this year, give or take.
Yep.
On the combined royalty. Yeah.
On the combined. Okay. But okay. So if they would double it, that would go to $1 million. Well, you're not expecting that to happen this year, so that would go to $1 million. But then
we can't say that would happen, but that I do expect, or I do believe that will happen at some point in the future because it just makes sense.
Okay.
And these guys are bootstrapping, right? So you don't when you're bootstrapping, you start off at the smallest possible kind of scale. You add pieces as needed, and so they've been doing a fantastic job of that, and just continually kind of boosting production, getting better recoveries, etc. And so they're kind of through most of those capital improvements. And then, the plant would be the kind of next step, obvious one to do. But obviously, I don't think that's happening in this market, right now. They just kind of got to get through this, next couple months. But yeah,
right.
no.
But so if they double production, let's say they sort of keep it there from then on, that would mean 1 million, but then you're going to give a third of that back.
Yeah.
So you go from 1.5. So that's going to be so basically expect this mine or this royalty to be giving you between $650 and $700,000 a year after the step back.
Yeah, in the future, if they were to double production and then step back, somewhere in that range. I think upside is tin prices. Quite frankly, I think our revenues are directly proportional to metal prices, and so I think tin prices. If tin prices double, our revenues double, right, as well. So that's kind of it happens with any of the metals that we have. But it was exciting to see with lithium. Last year, where lithium was $400 a ton for spodumene, jumped up to as high as 7,500 a ton. I mean, all of a sudden you're looking at projects and you're going, oh my God, my revenues now are 15x, where they were just a year ago. So I think some of that's gonna, obviously lithium prices come back down, but I do think there's potential for a multiple effect, on each of these clean energy metals over the next decade.
Right. I guess the risk there is obviously that cuts both ways, right? I mean, the tin price still sitting at around 25,000 a ton. It was supposed to be going back now with what's happening in Myanmar and all the rest, but it's not. And but tin's an interesting case. I can see the case for tin, and definitely watching that. What is They recently had an update, right? Sort of an update in operations. What's the good, the bad, and the ugly at Penouta right now?
I was all good right now. They had a shutdown once we gave them money back in January. They shut down the plant to do some upgrades with that capital, and since then they've basically been improving and steadily hitting new numbers. So yeah, I love that team. I mean, it is risky. Mining, you mentioned in the beginning, mining is a very risky business. I mean, that's partially why decided to start this company, was to do something different. You're a traditional single asset mining company out there. I mean, that's a very risky proposition. One project, there's probably 50 make or break, milestones along the way, 15-year development timeline, highly capital intensive. And so to do something, different, where we're diversified, we have 22 royalties, we don't have to put up the capital costs, development costs, none of that stuff. So, mining definitely is risky. This is one of the few teams out there that I really was excited to work with. This management team had already put in production several small mines, in Colombia as well. And so, having that experience, honestly, there's very few guys that have that, who've done that multiple times. That's really the reason why we felt super comfortable, going in on that investment.
Okay. Well, 650 to 700 out of one royalty is an interesting proposition, especially when you talk about it being, a 30-year thing potentially. What's the state of affairs for the zinc property in Tennessee? Are you still holding? Well, oh no, because okay, I was just thinking. I sort of answered my own question as I was asking it, but what's the state of affairs there?
Yeah, so we kind of briefly mentioned that we lapsed on our option that would happen in August. And so, like I said, it just didn't make sense for us, given kind of capital and some of the other deals that we're looking at doing. But it's a great royalty. Look, I mean, it's, vertically integrated with the Clarksville smelter, which is really the only primary zinc producer in the U.S. And that mine and the concentrate there is very clean. So it's, kind of strategic to that. And the smelting operations, obviously, I think they make about 10x, what the mining operations do. So they are, fairly important. So there's some kind of strategic impetus to have that mine going. Been producing intermittently for, over 50 years. I think it's about 2 billion pounds of zinc to date. So, we expect it's going to be producing for, a long time to come. Where zinc prices are, you mentioned the sliding scale. So I'll talk about that just kind of briefly. These contracts, that was an existing royalty bought. It's actually a pretty good one. It's a gross revenue royalty. The nice thing and our kind of why we're not worried that that's ever really going to be at zero. You might see that happen for 1 month, 2 months, maybe, is that in that contract, they have nothing to protect against inflation. So, if you look at the zinc price just from an inflation standpoint, 5 years out, it's at $1.40, and I'm not even talking about supply demand. I'm just talking about that. But ultimately, I do actually really like the zinc space too. I think for all these clean energy metals, the one thing that I can see clearly that maybe outside investors can't, is the supply side for these metals. Like I know all the projects, right? For all these metals, I know all the projects out there that, might be able to actually come into production. And, when you look around, I think for zinc especially, like, there's very few candidates for development. You look at the big mines that are producing a lot of zinc, they're, kind of tapering off and slated to come offline in some cases. So, I see the same kind of in tin, where tin's there's just no development projects. Like you can put every development project we have on the planet in production, and we don't meet where tin demand is 5 years from now. So, I know that there's a lot of, I saw the funniest article the other day, like copper bears selling copper right now, and it's like that way across the whole commodity space, because I look at it over the long term. There's only one way that this all kind of goes. And I see higher metal prices really for all these metals. But in the short term, people are, making their month bet about where copper is going to go this week and next month and that kind of thing. So, but the supply side, you can't change that,
No, it is true. Copper is sort of the commodity. It's exactly the type of commodity that nobody cares about until everybody cares about it, because it's gone up like 7x or something like that it did. What did it do, like 15 years ago or something along those lines? So how much money are you getting from Tennessee?
Yeah, so we're expecting it's going to pay us about $500,000, this year. There's a new Tennessee tax, unfortunately, that is kind of kicking into that a little bit, so it might be a little bit less. I think you mentioned, like, you were looking through our financials. People have looked through our financials to try and see that. We did set that up initially. We had to do it as a joint venture with Sprott. And so from a reporting standpoint, it's frustrating because we don't really get to put our revenues on our financials as we would. So some people have kind of said, hey, it's not, not paying what you say, but it is paying. It's just because of our kind of structure we had with Sprott and some of the initial costs that got filtered through that. But yeah, no, our expectation is to be kind of about $500,000 a year royalty for us, moving forward as we.
How long is that gonna pay you for?
Well, there's no deadline date on it. And,
what's the LOM?
So it's funny. It's one of those things in mining, like that mine's only ever had, it's operated intermittently, like I said, for over 50 years. It's only ever had kind of a 5 or 6 year mine life ahead of it. So, and it's like that for a lot of mining operations. It's really a capital allocation decision. Trafigura took this over from Nearstar about 2 years ago. Nearstar, not traditionally a great operator, but basically went under. And, so they didn't spend any of that money to keep adding to it. And now Trafigura owns it. And they're kind of a black hole in terms of information, so they're definitely spending money and like I said, that concentrates very strategic to that smelter. So there is impetus to keep it going, but it's hard. I don't get the information. That's one of the downsides. If you don't create that royalty agreement and you don't have that right built in where you can, go talk to the operator, say, hey, what are you guys planning? What are you guys spending, et cetera, then you're not allowed to do it. So it is what it is, but fantastic operator. I mean, I don't think Trafigura has ever gone into an operation and not, look to expand it or build it into something bigger.
There's something about the Swiss and sharing. They don't like it. So. It's okay. So, but we're looking at about $1 million from those two. Basically, that's it. What you're expecting, and then the one in Spain is eventually going to go to 650, between 650 and 700, contingent on obviously commodity prices. But those two royalties are $1 million already as is, basically.
Yeah, and some of those aren't necessarily our biggest paying royalties. I mean, we pay the most as you get closer to production and cash flow. And so because our G&A is so low, we definitely have made it a point we want to get, cash flow positive here, so that we never have to go back to the market, raise money at a time, when you're in a market like this. Thankfully, we also have our shareholder that's very supportive, so we're kind of spared that anyway. But yeah, but our other royalties we have in our portfolio, some of those royalties, like Battery Hill, for example, The economics came out on that. We're expecting that's going to be, anywhere from kind of 5 to 7 million a year. And they had a 48-year mine life. We have some economics on Seymour Lake that are expected to come out. I think that could even look better than that. So there are some royalties in our portfolio that are, a bigger amounts. Most of the royalties we expect in our portfolio once come into production are going to be about $1 million or more at least. None of the other royalties that we have we're expecting will be kind of subpar $1 million.
Right, but that's not for immediately though that you're mentioning right now. As far as I understand it, so but what you're saying here is you have $1.5 million in G&A. That's now though. I looked at some of the numbers. I saw that you've cut back, like investor relations went from about first half of last year was 250,000 to about like 60 or 80,000, something along those lines. So you've been cutting G&A as you should. But G&A is probably going to go up as you're growing the company. Not a lot, because that's sort of the function of a royalty company. Get it? But you're still not. I mean, with the royalty that you're getting, with the royalties that you're getting right now, you're still not cash flow positive because again, $1.5 million G&A, $1 million in revenue. When do you expect to get cash flow positive?
Yeah, so we have a couple of royalties in our portfolio that have the chance to enter production next year. OJ lithium royalty would definitely be first and foremost on that. So the North American Lithium Hub, there's a processing plant there. They are fully financed. They're actually in production. They've started to sell the very first of their concentrates. The OJ project sits right next door, and it's going through the final permitting process. They basically initiated that in February of last year. We can't tell exactly when that'll happen, but the expectation will be, my expectation will be in the first half of this year, coming up in 2024. And, the plan is to basically blend ore from Oche to ramp up production at that mine. And so, if they were to start that and that permitting goes ahead, that could make us cash flow positive next year, right? Our Graphmada royalty, that's, already operated for 20 months continuously. They've had all of their product qualified with off-takers. It's a huge extra step in the graphite space you don't find, say in the copper space. Those guys shut down because of COVID restrictions in the country of Madagascar. But if they were to go raise $20 million tomorrow, they could be back in production, in the next 3-6 months. And again, that would, make us cash flow positive. Ultimately, I think our plan is that, we're going to go out and execute one more deal ahead of that, a cash flowing deal. That'll take us there, ahead of those royalties coming on. But there is that kind of path where, ultimately you don't really have to do anything. And that the portfolio will kind of lift you. But, it's nice to have that. And it's always nice to have that portfolio lift. But ultimately, like I said, I think we're going to, probably go out and add one more producing royalty ahead of those.
Okay. Graphmada and, I guess Authier as well, right? The lithium project. And yeah. Well, that's exactly, yeah.
Yeah, it'd be part of the largest producing lithium mine in Canada.
How much would those two generate together? Yeah,
so they just changed the numbers around. It was over 180,000 tons a year.
I don't know what that means in terms of cash flow.
180,000 tons of lithium spodumene concentrate. I think if you were to use, say, a $2,000 a ton, price, that'd probably be okay for right now. And then if you wanted to, kind of times that by our royalty percentage, that's kind of the annual, cash flow you can get. It's a little tougher at Oche. So all of our royalties, except for Oche, cover the whole property. Oche covers about half. So it makes it a little bit tougher in terms of, forecasting and such. But it does cover half that project. So you could basically cut, 30% of the 180,000 is expected to come from Oche, and you could basically cut that in half. That would be kind of our, variable interest in it.
Okay. But the sort of what I'm hearing right now is I'm thinking, and obviously I'm speculating, this is your forward-looking statements that I mentioned at the beginning. 2025 onward, you're not going to have to raise any more capital.
Oh yeah, no, that's definitely not. I mean,
okay.
2025 onwards, if we achieve our goals, hopefully it's much sooner than that.
Okay. Well, how long would that still be possible if you didn't do any deals? Like if you just sit on your hands right now, or let's say again, the aliens, they took you, but they don't want me to operate. So there's nobody operating the business. It's just there. And the other companies are operating their projects, but you're doing nothing with the royalties. Can you still get there?
Yeah. I mean, I think if we were just to, let's say, draw down some of our facility and just kind of sit on our hands, or, I'm up in the spaceship and you guys are waiting for me to come back to kind of make a call on it. Yeah, I do see that path. I mean, the fact of the matter is we could sit here on our hands for 5 years. It might be the best thing for the company because, we see cash flows jumping up significantly from where we're at today. I mean, the 20 million valuation where we are today is just kind of crazy. So definitely lots of upside from, just kind of waiting things out, I think.
Okay. But why I ask that is because the market has not been kind to small cap operators of exploration companies. And again, 60% of those royalties that you're sitting on are in the exploration stage. So this was basically an indirect question. This is basically me asking, how confident are you in their abilities to keep delivering on their promises on time, given the current state of the market?
Yeah, well, typically they don't make any promises, right? But if you look at some of our exploration properties, like Rana, you'd probably consider that an exploration property. BHP is now part of that project. They're doing an exploration program with Kingrose Mining, committing $15 million to it. I think that's actually one of the more exciting projects, in the portfolio, even though it is exploration. Seymour Lake, those guys have raised $75 million in the last, 12, 18 months. They brought a major partner in. They're looking to fast track that to production. Kansas, I believe they just were looking to raise 150 million. So those are 3 exploration projects, but they have big money behind them. They have good teams behind them, good people behind them. And I think, we're picking projects where, we already know there's a big shortage of these projects within North America, Europe, and Australia. Like when we look at what projects could be a domestic source of supply, let's say for manganese, right? Like there's really one manganese project in North America. We felt like this could work, one. So we're like, okay. So we're already identifying the projects. Like we already like the project a lot when we get in. And so that kind of drives, good projects will get good money. We'll get good, forward progress. And so even Sleetat, right? That's our tin asset, our tin silver asset in the US. I mean, that's the best tin project in the United States. It's one of 2 that the USGS, in their own words, says might be economical in the entire United States, right? So from that point of view, it's kind of funny, we're just kind of so, at the very forefront of this thing, that we're able to kind of cherry pick some of these really good assets that have just been overlooked and nobody's really cared about.
That's again something that I'm thinking about. How does that work long term? And that might also be an interesting point to hear from you on. Where do you see this? This is a vague question, and I know I realize that, but what do you want of this company? Like, what do you want to make of this company? How do you see it?
Yeah, well, I mean, personally, I would love to grow, right? And because we have opportunities in the space.
What does that mean, grow? That's what I was. That's what I want.
Yeah, so so personally, I would love to be able to have more access to capital that made sense for us, so we could keep growing and keep adding deals. Because I think over the long term, you keep doing that. We've got I would say the best deal flow pipeline, because we've got maybe 100 deals that we could go do. If we had cash. And I know that a lot of groups out there, it's kind of the opposite, where they have money and they don't really know any deals to do. So from that point of view, it's frustrating. But, also I'm 95% invested. My family's a big shareholder. All I want to do is what's best for shareholders. And so, obviously right now in this market, it doesn't make sense to be, just taking money and trying to grow, So, ultimately I'm, just as concerned of a shareholder as you are, if not more so. And so just protecting shareholders' interests, and taking advantage of opportunities as we can,
But you can see yourself doing what you're doing right now for, let's say, the next, I don't know, a decade plus, or would you be looking for sort of an exit or M&A type of deal before that?
I think the royalty space is really like a highly consolidated space. If you traditionally look around, royalties, they come up and then they get bought out and you kind of go back to having 4 or 5. And, ultimately part of that impetus is the other royalty groups out there. I mean, it's hard we put a portfolio together of 22 royalties. That's a lot of work and time. And it takes as much time for a guy to say, I'll go buy you guys and get 22 royalties as it would to go put, one new royalty deal together potentially. So, ultimately, there's that kind of push to it. I would love to be doing this, and I think there's lots of opportunity to keep building this and keep growing this company, for 5-10 years. But ultimately, we'll do something along the way. Like I said, if it makes sense for shareholders and we all make money, I'm very entrepreneurial from that perspective. So,
so you
definitely keep open about it.
Okay. Well, that's just way too preliminary, right? It's a startup. You started 3 years ago? You said something along those lines. So there's definitely room to grow. And again, forward-looking statements thing that I said at the beginning. So this is in the realm of speculation. But you also mentioned, having access to capital, obviously important for everybody in the sector. What is the you have that convertible debt facility? What's the plan for that debt? I believe Gleason already has 19.9% of the company. So right now, unless you issue more shares, they're not going to be able to go higher than that. So are you planning on having to pay it back in cash, or would they be willing to come in on future financings?
Yeah, I'm not really worried about having to pay back that in cash. If you look at where we're at right now, yes, he can't convert. But ultimately, the term on that is, 3 years, because he can't convert if he goes over 19.9. But, over a 3-year term, we just started drawing down on that, in January of this year. So we have a pretty long, runway. We expect that the company is going to be a little bit different company. There's going to be room for him to convert. He's a very favorable shareholder, a very supportive shareholder. We've had discussions that, none of them have been about us having to pay him back in cash. If we ever really drastically needed it, I'm sure we could, extend the term. But it's, like I said, this is the kind of loan that you only get from a very supportive shareholder. It's probably half the cost you get from a private equity group out there that does this in the space. And it's no interest payments, no capital repayments, all tied up till the end of the term. The conversion price on the shares is, much higher than where we're at today. So, it's very friendly. We're very grateful, to have him, as part of this and to have that capital at a time where there's good deals to be done.
Well, it sure is, right? I imagine that the knife sort of cuts both ways, being a royalty company, right? As in, your stock is down, sure, and that's not nice to look at. And it's not great in terms of if you had to finance, so in terms of dilution, all that. But at the same time, the companies that you're supposed to be doing deals with, meaning the companies that you're supposed to be financing and essentially buying the royalties from, are starved for cash too. I talk to people. I think I interview about a company a day or something along those lines, and that's what they tell me. We need labor and we need access to capital. You look at some of the charts. This has been the worst year in over a decade for financing juniors. So they're starved for cash, which means supply demand. Basically, you're getting cheaper royalties. That's what it comes down to. So how do you manage that balance, though? Is it like, is Gleason really the key balancing component of you getting that balance right?
Well, I think just for the moment, right? Ultimately, there's definitely bigger capital out there that's looking to get into this space. And I think there's strategic investors out there for us. I just think right now in this market where we're at right now, we're just not willing to, entertain anybody trying to be, aggressive and say that we have to take equity at these prices. So it's nice to have a shareholder like Stefan where we don't need to, and he will give us access to capital as we need for a deal, so that, the bankers and the brokers out there, don't try and become vultures around us. But longer term, I think there's going to be other money. I think if you look at what we did, say with Sprott as well in the co-investing, where they put up 100% of the cash to get that deal done. I think there's going to be deals like that to be done. We definitely could do another one like that if we needed. And, I think there's some unique structures out there where we can probably surprise people with the amount of growth that we get done, without having to even use cash potentially. So, I think there's some interesting kind of options and avenues. But yeah, right now, Stefan's been, kind of a very nice pillar for us to have. I mean, we've really just drawn down on that, facility this year to close different deals. So we haven't had to go back to market. And, right now, especially, I think it's probably paying the most dividends.
Do you think the market really is ready to care about any of those? I mean, like becoming a cash flow positive company is usually a big catalyst for royalty companies, obviously, and you're on your way to become one soon, as you said. I also think the story has been communicated well enough. Like this is not it's a relatively new story, but it's not brand new and it's not an unknown story either. Yet the market again doesn't seem to care much about anything right now. So you're not obviously not the only one. And so your share price again close to all-time lows, as you said. So what do you think? What do you think changes the market's perception here? Is it just sentiment in the broad markets and something macroeconomic related, or is it something that you can do? Like, can you go and do a deal that just shocks the market and re-rates your stock to where you think it should be?
Yeah, well, that's kind of always that's kind of my plan. It would be kind of multifaceted, right? So, like, yeah, I'm hoping that we're gonna do a deal that's gonna be a fantastic deal. Hopefully, kind of wakes the market up to where we're at, and hopefully it's a transformational deal that does move us to kind of a new spot. I think getting the cash flow positive, yeah, traditionally a big milestone for any company. Definitely in the mining space, as well for royalty companies. I think for us that's just nice because then it kind of just let's look if we're that cheap and we're cash flow positive, we'll just keep buying our shares back, with the money, right? So I think that's kind of where I'm at right now. We're so cheap that if we get any cheaper, yeah, I'm gonna start selling body parts and cars and whatever, take on debt, so that we can buy our own company back because it's gotten that crazy in my view. But so that's so I'm not too worried about it, quite frankly. If we're going any lower than where we're at today, but it's I'm hoping that we do a deal that is transformational. We're always looking to try and find something like that, and we usually have our teeth in 3 or 4 things like that at any given time. So that's always the hope. But in this market, you never can really promise anything. I think that's the nice thing about if we can get cash flow positive, we don't really have to depend on the market. Unless the market's there.
It's a good point. Because you take money when it's there, not when you need it. That's what I'm learning in this space. Are you gonna stay focused on the US and Canada? Because again, as I said, about 70% of the royalties that you have are in the US and Canada. Is that by choice or did that just sort of happen?
So I think, like we're really targeting Europe, North America, and Australia. I think, you see a lot of our royalties are initially here, Canada, North America. I think that's, probably because we're based here. So we have a little bit of an edge, in terms of this is our backyard. And so all the people that we deal with, traditionally on a daily basis, they also play, around here. So I think that's probably part of it. But I do really like, a lot of the opportunities in Europe and Australia. So, I wouldn't say that we're necessarily focusing in on intentionally. I think it's, partially a lot of the initial deals we had were based off of, we knew people here and have relationships around here.
There's not much in Latin America, South America. So
yeah. And I used to love Chile, as a mining jurisdiction, as a place to go, like, and it's just been so tough to watch what's, been happening down there the last couple of years. You see what happened in Peru. You see, even Ecuador recently. It just, I think there's plenty of opportunity down there. And I'm not saying that we wouldn't go down there, but we just see there's enough opportunities right now, in Europe, North America, Australia, and really trying to still pick up those best projects in those jurisdictions. But yeah, it's just tough. We don't do Africa. There's 2 countries in Africa that we'll kind of look at, maybe 3. But jurisdictional risk for us is, maybe for me, is just not something that I want to take on if you don't have to. A lot of our first clients when I started with Endeavour Financial in London, there were a lot of African clients, and it was a lot of, camp got stormed by rebels today. All that work you did on a project financing is, it doesn't really matter anymore. So I guess from my background, my experience, if we can take jurisdictional risk out of it, let's do it.
Okay. Well, that's a fair point. How long did you work for Endeavour Financial, by the way?
I was only out there for a year. I got a work visa. Born and raised in Vancouver, but it was a fantastic year. It was kind of a funny year. I mean, when I got there, gold was at about, I think, 1900 or closing in, and dropped to 1,300 about 2 months later. So we had about 5 billion in planned gold debt financings we were planning to do, and it's kind of funny that what they were looking at financing back then. But yeah, it was the beginning of a kind of a tumultuous period. All the banks that were lending back then and doing those debt deals, within a year or two of that, they were all gone. Basically didn't exist, and most cases they haven't been brought back. And so yeah, just kind of interesting. But yeah, no, really good experience. The first deal that I ever worked on there was $1.2 billion debt financing on a copper project down in Arizona. So yeah, you can't really replace that. But it's it's a small space. There's not very many advisory groups out there like that.
Right. What did you do in between, by the way, between Electric and Endeavor?
Yeah, so I came back to Vancouver and I worked basically with most of the mining houses in Vancouver. King and Bay West and the Fiora Group, the Hunter Dickinson Group, just various different roles. And then I ended up actually starting out on my own, not a little bit earlier than I wanted to, just advising companies on M&A, project financing, debt financing, that kind of stuff. I think I was 25 years old, and the average age of the board members was about 80, for my first client. So, it was kind of interesting, but it was tough. Like my second place I worked, they went from 40 people to 10 people, over the course of a year and a half. And so, I was kind of pushed out to start on my own because no one was hiring, and that was really the only way to kind of keep, working and doing it. So. The rest is kind of history from there, I guess.
I really hope it worked. I really hope it works out for you, because it seems like you're enjoying it. You're always smiling. I've watched a couple of your interviews, so it seems like you enjoy what you're doing, and I'm always happy to see that. So I think that's it. I don't have any other questions. Is there anything that you came here hoping to talk about but I'm failing to bring up?
Honestly, I was just hoping to make it through and not get too charred. So that wasn't too bad.
No, it wasn't. It was a good pod. I enjoyed it. Thank you so much for sitting down with me.
I appreciate it. If you ever want to have me back on, I'm sure you'll have more questions. We have 22 royalties. We didn't even touch on most of them. So I'm sure there's more that we could walk through for sure.